Now we're going to look to rising yields, what's happening with some of the movements in general on fiscal policy, and really what are some of the inflationary drivers and what is that going to do to rates in general over the next few months. So when we turn to and I think this is a great chart from the BCA research. When you look at after the boost, and we've seen it, we showed it in retail sales. We'll talk about retail sales in a little bit. You get this shift. The consumer has more money, they do more, but then you get almost a drag, this negative fiscal pull through in. And I think sometimes that is missed when you get this shot in the arm, but you also pull forward demand. So you're not creating new demand, you're just pulling it forward. So you'll get this great number, but then you don't have it. It's not perpetual. And that's where we start coming back to, is it better to give somebody $1,400 once or give them a job to give them $1,400, a week or something along those lines to create some of this long term, but you can't just give them according to MMT, you can give them $1,400 a week without issue. But in the real world or in real life, you can't do that. And that's where you start to have to look at, you have to factor in, can we give jobs? Can we provide construction? Can we rebuild dams, water systems, bridges, roads? There are things that will have a lasting effect on our underlying economy. And right now, when you look at just the deficit, surplus, the surplus, wouldn't that be nice? So the U.S. Treasury federal deficit continues to outpace expectations. Shocker, I know. But this is going to become a bigger issue when you look at what is the yield, the offering schedule, because we've seen a big increase in the amount of debt that's going to be put into circulation. We had a fairly soft 20-year auction, and there's just been more. And we have the schedule coming up, just so we can talk about that a bit more. But it's really to cover this growing deficit. Now, this is something that we talked about in the FSC show. We just want to highlight just the inflation side because we're seeing some of these adjustments. So when we look at the correlation, so on a seasonal adjusted basis, the cash shipment index fell 3.1% from March to April, giving back most of the increase of 3.4% increases in March. So it's not that we're seeing any kind of residual move down. It's just this back and forth. And remember, we talked about it. March is a slow period in terms of movements, and that the hope was that we were going to get a resurgence, or the activity was going to stay elevated to help normalize the system. And it didn't, because we're so far behind and getting further behind, back to the point of the stimulus of pulling forward some of this demand and really actually hurting inventories more, which is why we would expect some of these shipments to go higher. Now, even though the shipment side went down, rates went up, and the embedded rates rose another 3.4% month on month on a seasonally adjusted basis, following a 3.5% increase in March. Now, if you look at what we talk about in the EIA show, especially segment 2, diesel prices haven't gone down; they've gone up. And remember, diesel is a pass-through. Not only has diesel gone up, labor has gone up. Truck drivers are getting paid more, and they're getting sign-on bonuses. Both of those things are pass-throughs, so we're going to continue to see the increase in the in pricing in general, and this is why. Well, look at the ACT for hire trucking index, driver availability. We're at the biggest shortage we've actually really seen in a very long time, which again, driving up labor, driving up that pricing that we continue to see. Now, while all of these things continue to happen, well, let's look at the hard data. So the Citi U.S. Economic Surprise Index, hard data is getting worse, which means that we're missing the data to the negative side, which again is not that the market cares or continues to ignore. And the reason why I talk about the surprise index is because the market acts like everything's baked in. And if it's a surprise, just based on what estimates are, it's really not, it shouldn't be baked in, but the market treats it like that. And I think these are some of the differences that we need to look at when you start talking about, well, how much stimulus is too much stimulus? Like, this is what 15 trillion has bought us. Like, this is where we sit. We have $15 trillion that is in circulation, or since all of this started, or 12 trillion, and I'm just really 12 trillion with another 3 to come. And this is where we are. So what is throwing another 15 trillion at it going to do? What are we really trying to achieve at the end of the day? What is the end goal? Because the only people I see this benefiting is the top 1%, while everyone else continues to get left behind. We can talk about that from commodities and other, but again, these are the pressures that we're seeing. Now, some of the other pressures, especially when we start talking about labor and people coming back into the workforce, well, what about bankruptcies? How many bankruptcies have been announced? How much is going to continue to come through? And so far, announced U.S. bankruptcies by year, we're at 183 year to date. In 2020, we were at 207. So we actually have a fairly, just given where we sit in today's world, given the fact that we were in a recession, we're actually pretty low for the current area. Now, the bottom one is with public debt. So given there's more bankruptcies on the private side, but here's just something that's, I think, interesting when you look at it against previous years. And I think there'll be an acceleration, especially if some of the consumer is slow to come back. We see some of these headwinds remaining in the system, which again will kind of keep things fairly limited in terms of growth. And the announced U.S. bankruptcies in 2020, 2021 by month, it's something that I think you'll start to see a little bit acceleration. But when we look at the index of bankruptcies in general, and this is just looking at last pre-recession quarter, when we look at other recessions and the global financial crisis, the great lockdown of 2020, you had a lot of PPE, you had a lot of global support coming in. And the question is, did you save things worth saving? Did you create more zombie companies? And again, there are arguments for both sides, and I think there's a lot to be said about each one, because I do think some support was absolutely necessary. I know personally I struggled significantly on the business side, and again, like I know I wasn't the only one. So that's why I think there was some support that was very much needed, that provided some of that needed boost to get to the other side. But now that we're at the other side, how much additional is necessary, and are we going to reach the point of too much? And that's where we turn to the maturity range. So when we look at the Fed schedule, you can see the amount that has been increased in terms of the levels overall, where now it's been spread across the curve. You have the 7 to 10 year, 10 to 22 and a half, 22 and a half to 30, have all been added and broken up into pieces to increase the throughput. So you had this 20 to 30 year of the 6, and then you've actually increased the flow and increased the amount across that time period. And again, just additional paper, additional pressure. We're already seeing a struggle on the buyer, because the biggest buyer has really been the U.S. Fed. So the issuance of U.S. Treasuries versus demand by sector. So when we look at who has been the buyer in general, it's pension funds, which is not really a surprise, because typically they're just rolling from one debt to the next. But the Fed has been the largest buyer of U.S. Treasuries, and this is why they say they want inflation. But they don't want inflation, because if they get inflation, if they get what they actually want, they can't keep doing this. And it's this catch-22, because they need to keep doing this, because there is no buyer that's real. Because let's be fair, if in order to attract a buyer, you need a higher interest rate. And to get a higher interest rate, you're going to have to see demand go down, and the Fed is the demand. So if the Fed goes away, where do interest rates go? Where does inflation go? And I think this is why they really try to talk down inflation, call it transitory, call it whatever they want. But what is transitory? I mean, the Texas freeze-off is transitory. Colonial Pipeline is transitory. do you tell someone after 2 years, oh, it's just transitory, as they're sitting there scrimping by to buy stuff, to buy, just pay their mortgage, buy food? You're like, oh, don't worry, it's transitory. Well, after 2 years, it's no longer transitory. And that's I think, some of this big flow that has to be understood. And that's when we start looking at the 30-year and the overnight. So the overnight, as we said in segment 1, we're almost at $300 billion getting pushed into the overnight Fed window because there's no taker. There's so much liquidity sitting at the bank that they have they can't invest it anywhere, so they just give it to the Fed to get some nominal rate, close to 0% or so. And that is its own problem, because as the banks start to lend, then you get velocity of money. And what happens when you get velocity of money? Well, you get more inflation, because you get, the acceleration is going to increase the movement through the system, which increases volumes. Again, there's a lot of problems where you're sitting on this huge pile of liquidity that's doing nothing, and we have inflation. So what happens when the pile of money actually starts moving through the system? And that is, I think, where some of this inflation expectation of, oh, it's transitory, it can stop being transitory real fast. And that's where, when you look at the 60s into the 70s, because let's be fair, how many people really have experienced inflation? I'm a crazy reader. I like to study history. I like to study other countries. So we've been exporting inflation for the last 20 years. We've been in a 40-year bond bull market. We have the benefit of being the world's reserve currency. So we haven't experienced inflation the same way, but it can run quickly and without reason. And that's where, or with reason. But again, there's a lot of these pitfalls that I don't think are appreciated, or landmines that live in the system that can keep that pressure, especially when you look at the 30-year bond yield, which continues to push higher. We think this breaks out and then pulls the rest of the curve up, and especially the 10-year, because as the 10-year goes higher, that's going to stress the emerging markets all the more, because that's what they're basing things off of, which is why when we look at the U.S. break-even 10-year, that's when you continue to see this push up, at that 2.5%. As that continues to pull up, again, that's going to put more and more pressure on just the underlying level. And that, again, this is the break even, because as inflation goes up, then real rates, you have to look at the different yield curve and what is the yield curve saying. But as there's just that upward momentum, which again will keep pressure on rates in general, which is why when you look at other things that the Fed is buying, well, they're buying mortgage-backed bonds and mortgage-backed securities, and this is what they've purchased, are almost $2 trillion of these agency bonds, which has kept rates low, even while some of the risk might be increasing. And this is when we start looking at the 30-year mortgage rate versus what's happening in the housing market. And at some point, this has to slow down or normalize, or at least stop going up. And this is where you could also start to see pressure in the mortgage market and rates continuing to go up, because I think this is going to be one of the first places to slow, even without they'll keep trying to buy the bonds as much as the treasury bonds as much as possible. But I think this is going to slow, and this would be the first period of tapering, and that would also take some of the air out of the housing bubble. Then when you look at how are they squeezing rates? Well, the presence in the mortgage market has pushed bonds to their limit, with U.S. MBS, or mortgage-backed security options adjusted spread. You get an idea of just how cheap they are, which is keeping a lot of that pressure in the market, which again is something that we have to consider, which is why, not to say that it's going to explode back to the upside, but as they start to pare that back, we'll start to see some of this trend closer to that 0.4 versus essentially near zero. Now, this is just a quick one that I just wanted to highlight, and then we'll break it off into pieces, because obviously there's more, because this only goes to the 14th. But when we look at retail sales, when we talk about that pull forward, here you can see, the expectation was for 1%, came in at 0%. And when we look at just the control group, it was expected to be at negative 0.2, came in at negative 1.5%. And that is its own problem because you have those sales slow. But again, April was supposed to slow because March was so strong. You had that pull forward from the stimulus coming through. But you're going to continue to see some of this stagnation just based on what we're seeing in the market. All the while, import prices are going up. So import prices were expected at 0.6, came in at 0.7. We can talk about year over year, but let's keep to month over month. Export prices at 0.8 versus, it coming in at 0.8. That's where we're continuing, again, movement higher in pricing, which is why when we turn to the sentiment and the University of Michigan current expectations, current conditions, things are starting to weaken because people are seeing the inflation hitting them. It's very much tied to gasoline. For those, we talk about the price of gasoline in segment 2 of the EIA show. That's continuing to get worse. That's continuing to be that pressure. And I think the pressure point is getting, worse and worse when we look at, in the past, like I said, it used to be $3.50. I think it's now closer to $3, $3.05, 10 cents. That is going to keep that pressure really capped in general. And when you think about, that capping and what is, where could we see more inflation? Where could we see more pressure? Well, you could see it in wages. And that's why when we start to look at wages in general, given that they're still slow, they're not seeing that average hourly earnings year over year, but you're starting to see some growth. And that's when you start to see some of the increases in general where you saw it run really hot. Now you're starting to see it slow down. The Atlanta Fed wage tracker hasn't really accelerated. And that's where you see some of the slowdown where you'd like to see some of this growth, some of these benefits, and we're just not seeing some of these movements. So the heat map shading is calibrated to levels of growth rates that have been associated with tighter red or looser green monetary policy in the past cycles. So typically, we're seeing these slowdowns and we have very loose monetary policy, which is why we talk about this. Like, what is the end goal? If the end goal, clearly what you're doing isn't working or not working the way it's supposed to, again, back to law of diminishing returns, back to the Cantillon effect of how do you get it to the right hands? And these are the pressure points where we continue to see on jobs, on the jobs level, and what some of the issues are in as we go forward. But all net job gains in April were in the low wage section, which is what we were talking about. So there's the commentary that there's too much stimulus in the market for unemployment, but low wage jobs actually went up where high wage and middle wage went down. And I think because, again, some states had already gotten rid of the additional benefits. You had some states that never had them. So you're going to start to get some of that normalcy because people do want to go back to work. There are people that want to work, and it's at the lower wage side. And this high wage, middle wage, I think is going to be the bigger overhang because the low wage individual doesn't have the capacity to spend. And if those net job gains aren't coming back, well, this is going to be a bigger hindrance because a lot of these jobs that are available are lower wage. So if you're out of work longer and longer on the high wage, middle wage side, that's going to be its own impediment to getting back into the workforce, which is why when we turn to the percent of unemployed who have been out of work for a year or more, it's continuing to rise, where you look at 52 weeks or more, you're almost at 30%, and 27 weeks or more, you're almost at 45% of the unemployed. So a lot of the unemployed left have been unemployed for a very long time. And just like I've used this description before, warm stacking versus cold stacking, do you want someone who's been unemployed for a month or someone who's unemployed for a year? Who's going to need more training, more time to catch up? And again, these are some of those headwinds that remain in the system. So then when we turn to and look at what has happened on the UI benefits, this is where we always look at the unemployed assistance, the emergency. You can see the acceleration from April 17th into April 24th. And this is why we think that we're going to sit around 17 million people on net benefits in general on a rolling weekly basis. And this is just looking at the Atlanta Fed wage growth tracker, which still remains depressed. And then when you look at full-time workers, so the Atlanta Fed wage growth tracker for full-time workers, and then just the average in general, we're not seeing the acceleration. And this is a good and bad thing. And well, there's a lot of bad in it, but good on the inflation side, because you're not seeing wage inflation. So without wage inflation, you're not going to see those additional labor costs getting pushed through, though you're seeing it in pockets. But at the same time, if you're not giving people more money on the wage side while their prices are going up, well, then how is that going to work? You're still, you can't tell when you're at the grocery store, you can't tell the person ringing you up, oh, by the way, I didn't get my wages increased for inflation, so I can't pay for this inflation. That's not how this works. Like, you're going to have to pay those prices, which is going to again pull through from your savings, from other places, or again, you're going to scrimp elsewhere. So other areas, which is again going to be that overarching overhang. And then when we look at some of the sub-industries have lost 3/4 of private service jobs, this is where we start looking at services providing on the private side, the net loss, and then where we continue to see them: food services and drinks, admin and support services. Some of these things, especially admin and support, you're just not going to see the same level of hiring for that because I think people are trying to do more with less, coming back to trying to keep costs low, especially on the labor side, because you already have such elevated costs. You really can't pass through all that much more, again, leaving with some of those overhangs, and now in the next segment, we're going to go through a bit more on the inflation side, looking at housing and some of the other impacts that we continue to see on the inflation, and then what comes next, really.